I'm sorry for the trouble. So, so my first slide, I was just making, a case study wherein, it is not about how much wealth you have in your life to, keep you above water or, meet your life desires, financial goals, etc., etc. It is all about how well you are able to manage your finances and have a financial discipline will end up your, achieving your life goals. So in this whole session, I will be covering three major areas. One is about the financial wellness part. Number two, I will be just briefing you on the financial products, different financial products available in the market nowadays to invest. And finally, the financial planning part, or the financial goal-based planning part. So when I talk about financial wellness, many a times we all go to the gym or either to the yoga center to keep yourself physically fit, and you will have a gym instructor or a yoga instructor to give you the guidance to how to keep yourself physically fit and have your six packs and all. There are spiritual guidance and spiritual fathers who help you to keep up your spirituality as well as your emotional wellness. There are people who again do yoga and other emotional therapies where you keep up your emotional balance well in life. Similarly, to have your financial goals achieved and how to manage your investments, there is a concept called financial wellness, wherein you approach a financial advisor or a financial investment advisor who will help you in managing your finances as well as investments, how to invest, where to invest, and the planning and the rebalancing when it's needed. So of late, many of them are approaching a financial advisor or a consultant who could help you in getting your finances rightly placed. So now let's see, the beginning of this concept of working to earn your living. Genesis chapter 3 verses 19 says, "By the sweat of your face you shall eat bread till you return to the ground, for out of it you were taken, for you are dust, and to dust you shall return." So from the time of creation, God has created man, or rather, uh, you know, he expected every man to, work for to earn your living. So that is how, it is meant for every human has to work for his living. Because in many of the ministries when I was involved, many of the Jesus youth also had a misconcept, like, once you are into ministry, you have to just trust on the Lord and move. And many of the times I've seen many of the people were not really working to earn the bread or earn the living. So initially itself, let's understand this concept that Lord has created us to work hard, sweat, and earn our living. Once you start earning, then comes the part of investment and how to spend your money and all those concepts. So let's beginning with the start of earning money. So again, I was telling you, about how to achieve this financial freedom or how to earn, be a smart wealth builder. So first, in this, you have to understand your financial status. That is the first thing. That's what I was asking you. What is that amount you require in life to give you that comfort or achieve your financial goals? So first thing is to understand your financial status. Basically, how much you earn, what kind of life status you want to maintain, That is something which at a very first question each of you should ask yourself. Then only that the other things of how to make this money, how to achieve that question is relevant. So first is to understand your financial status, set your life according to the financial lifestyle you decide to have, because the lifestyle which Tito Mathew is desiring and setting may not be applicable to Robin, or may not be applicable to Ria, or may not be applicable to Neil. It is each person's financial need and requirement is totally unique. That is first thing you have to set in your life. Number two is, based on your financial status, you have to set in your financial goals. Basically, how much money you need to earn, or how much wealth you have to create to buy a house or buy a car, or even for your livelihood. All these depends on the financial goals what you set in your life, depending upon the financial status you have achieved. Number three is, make an asset and liability statement. That is very important in your life, because first of all, you need to understand what is asset, what is liability. At this point, let me ask you a question. Is your house a asset or a liability? You can just type in your chat box. Either you can type it as asset if you see, or liability if you see. Rupesh has said it's liability. Anybody who says it's an asset? Okay. See, Robert Kiyosaki in Rich Dad Poor Dad, he has very clearly said what is an asset and what is a liability. Any instrument or investment which gives you return is asset, and any investment or asset which gives you have to pay back is a liability. For example, many of the times we will be buying house with a housing loan. So in the lifetime, we have to pay the principal, the interest, the maintenance of the house, everything takes out your money. So wherever a asset is meant to give you returns or money, and something which takes away your money is liability. So there is a clear-cut demarcation in your net worth or wealth you have to make between asset and liability. So you should create more of an asset with your investment. That is the target when we are doing investment. It is many times people buy first house with a housing loan, then they go for a second house, but eventually they don't realize that you are lifelong working to pay off all these debts which you have created out of your loan. Number four, which is very critical and important to maintain a financial discipline, is to maintain a daily account tracking of your expenses. Because this is something which I have been following from my days where my career was starting, and at some point I was getting off track with my spending, where my money is really going. So then I started this so that is where when I started putting out each and every day's expense into an Excel sheet and daily updating that Excel sheet, which gave me a clear-cut idea how much money I am earning, how much money I am spending, where is my spending going. Because nowadays I don't think Excel is also outdated. I would suggest to have some mobile-based app tracking. There are a lot of apps in the App Store where you can on a daily basis track your expenses. Even now smart apps are there where they read your SMS from your bank withdrawals and your online payments, and it is automatically updated. Where in end of the month you can track where is my money being invested or spent. Because going forward I will be explaining you how much money has to be into each creation of savings, expense, and also a daily tracking of your financials is very important when it comes to the discipline financial management. Again, you should clear-cutly differentiate between your spending and investment. Like how I said, you have to have a asset and liability statement. Again, each and every spending what you do should be like, you should think whether it is a expense what you're incurring out of, like, for example, you are buying your household, grocery. It is a expenditure what is happening. But when you are putting your money basically into a investment or a savings, it is basically where you are keeping aside your money for investment. So these are the 5 basic fundamental discipline which you need to follow to achieve financial wellness. One is the understanding of your financial status, what is your income from your profession or your business. Number 2, set the financial goals, what all you need to achieve in your life. Number 3 is to segregate between the assets and liabilities, because you need to understand what is your particular investment or asset is taking, whether it is draining out your money or whether it is earning your money. So that is how you need to segregate between asset and liabilities. Then the daily tracking of your daily expense, and finally differentiate between spending and investment. So these key fundamental concepts you need to understand to achieve the financial wellness. Let me now come to the financial products, give you an overview of some of the common financial products available in the market. In general, if you see, you can categorize each of your investment or financial assets into 4 different categories. One is the payment and transaction based category, then the investment products, we have insurance product, and the loan product. Basically, the savings bank account where your salary remittance comes in, or your business income comes in, is more or less it's on the savings account. Then some money you keep here into rupee or rupee and other wallets where on a daily basis you do it online transaction account. So that is one part of it. Then investment products, if you categorize, it is basically fixed deposits of savings bank, recurring deposit from banks, your PPF and the PF account from the employer, or at times you have it from yourself opening PPF account, national pension scheme, mutual funds investment, equity, gold-based investment, and real estate. So on a broad basis, these are the certain investment products available in the market. I will be discussing in detail many of these investment options in the coming slides. But at this point, let's understand each category of investment. Then comes the insurance-based products to protect your financial losses or protect your assets. We need to have insurance, especially life insurance, accidental accidental or health insurance, motor insurance. All this insurance is to protect your asset as well as save you from financial losses. Then we have loan-based products for basically wherein we create assets through loans. I was talking about housing loan, education loan, car loan, personal loan, and credit cards. Basically, credit cards bank gives you loan for a very shorter period, but if you don't pay, you have to pay the interest. So basically, to understand what are the different product or category, it is predominantly 4 categories. Now, whenever a financial advisor or a investment planner comes to you, he will say, "Sir, I have a product which gives you, double the return in 3 years. I have a product which gives you wonderful return, 50% kind of return per year." A lot of jargons and gimmicks you will be hearing. But whenever you are analyzing a investment product, you need to have these basic parameters to be asked specifically to the advisor and take your decision. So this will help you in basically taking a prudent decision on an investment product. So first question to think is whether the return out of this investment is going to be fixed return or variable return. For example, when you are investing into a bank FD or a bond, it gives you a fixed return. They will say 6% is your coupon rate or interest rate, or 7% is your interest rate. But in certain products, they will tell us, sir, you will get as high interest as 15% and 20%. Then you need to ask whether this 15% or 20% is a fixed return. If he says yes, then you have to clearly ask him, can you give in writing? Many of times they try to missell you with products with high return, but it is subject to market conditions, or some variable factor will be there. There is no harm in putting your money into variable return instrument, but you need to understand what kind of return it is going to give you or how it is going to come back to you. Then the asking is the safety of capital. Many of times we have to understand how safe is your money. The principal is going to be guaranteed, or it is going to be risky, or the variation also will happen into principal also. That is very key important question to be asked. Then comes the taxation, because there are products which gives you high return, but there are high taxation also on those investments. So you need to be very careful while doing an investment. Before that, in doing your investment itself, you need to check what is the taxation on that investment. Then again, the investment horizon, because you might have some amount which you may require after 2 years or 3 years, where you want to take a career break and go for higher studies. But then there are investment wherein which is locked in for 5 years or 10 years, but which cannot be withdrawn during the interim period. So again, you have to evaluate the investment horizon of the investment what is suggesting. Then comes the liquidity part. How easy it is to sell and take your money back. So, for example, in certain asset class like real estate, there is a time of a conversion from real estate to money, because you have to find a buyer. A buyer has to be negotiated, and the deal has to fix. Again, after fixing the deal, there is a time gap in coming getting back your money. So you need to be very clear, the particular investment he is suggesting, whether it is easy, liquidatable, and get back your money. Again, flexibility is something more or less connected to liquidity itself. What is the fixed lock-in period, or how much time it takes to get back your principal again, as well as the returns of it. Then the cost of the money. There are a lot of instruments in the market which has a chance of giving you high return, but there are costs involved in. So there are like management fees you need to ask and get it clear. How much percentage the product will charge us in giving us the return or the management fees? Is there any entry charges, or is there any exit charges? Because some products are there where there is high entry charges. There are some products which doesn't charge high entry charges, but they have exit charges. So another point is just to have an analysis on the cost. Then the transparency and the reporting. That is very key, because most of the cases, what will happen, like many of these Ponzi schemes, which comes, like in 6 months your money will be double, 1 year your money will be double. We don't know how this money comes in. So that is something which very clearly you should ask, and you need to understand how this money is coming back, in what instrument they are going to invest, whether they are going to gamble with this money or how it is coming. All those transparency should be there. You should ask for the investment memorandum, basically, in terms of mutual funds and other products. There is an investment memorandum which you need to ask and understand how basically this money is going to come back. Then the ease of investment. Nowadays, we need to have the online facility wherein anytime you can log in and use it, or whatever way of report generation is required, which is convenient to you. You need to understand. And so basically, these are the key points whenever a investment product is pitched to you from a investment advisor or a consultant. You need to ask and understand on each product. Fine. Now let's evaluate different types of investment which is legally allowed, because I want to make this concept very clear that whatever investment you do, it has to be covered under a legal framework, and there should be a regulator who regulates the investment. Regulator who regulates the investment, what I mean is, in case of banking, we know the regulator is Reserve Bank of India. RBI basically governs the banking system in terms of their operation. Similarly, in each investment when you make, there should be a regulator who gives the guidance. So all these investment opportunity have listed is regulated by a government regulation available in India. One is this stock investment, which is either you can do a private stock investment or a public stock investment. For example, my company, AMJ Stockbrokers, is a private limited company, and we have a lot of shareholders who have subscribed our shares, are partners with us, and we do give them the returns when we earn profit as dividends. So similarly, there are public limited companies like the Reliance or the Tata Groups or the many other companies which are listed in the stock market, wherein you can buy those shares when they are issuing in a public issue called IPO, or you can go to the stock market or stockbroker and buy from the stock market and earn dividends as the profit share, or the we call as capital gain, which happens on the price appreciation. So that is very common investment which everybody follows nowadays. It's stock investment. Then comes the bond investment. Bond investment is either there could be a corporate bond which the private companies issues, which says a coupon rate of 8 to 10% is what in a corporate bond it varies. Then we have government backed up bonds, which is issued by state government or the central government, wherein the risk is very less, but the returns are also very less. It comes like 6% or 7% max. Then we have banking, savings, and fixed deposits, very common, which is like in SB account, the SB interest could be around 3% or 4%. In fixed deposit, it could vary to 5% or 6%. Very simple mode of investment. Then long-term savings, where PPF, EPF, National Pension Scheme from Post Office, all these are like mostly for 10 years or 15 years, where you'll get slightly better return than the government bond, but it's locked in for long term. For a short term liquidity requirement or some investment or some liquidity you need for meeting your immediate need, you may not be able to withdraw from PPF or ETF. So that it is another mode of investment. Then comes the mutual funds. So initially I was talking about stock market investment. Not everybody can have the time or know-how to get into direct stock investment. So for them, the easiest way to enter into equity stock market is to get through a mutual fund, where we tell us equity funds, wherein the funds invest into stock exchange listed shares, and the fund manager manages it on behalf of the investor, and the investor gets the return out of it. Again, in mutual funds, there are different categories like debt based or the debt bonds, bond based mutual funds are there. Then there are mutual funds which invest only into gold, gold funds, where the returns based on the gold returns. In debt investment, they invest into private or government bonds and give you the return. Then we have index based fund, where the funds invest into different indices of the stock exchange, index-based shares of the stock exchange, and gives return. Then we have ETFs. ETFs is exchange-traded funds. Like there are gold exchange-traded funds, there are liquid exchange-traded funds. So for different investor requirements, there are different category of mutual funds where you can select and choose based on your risk factor and this appetite to invest. Then, of course, the real estate, traditional real estate investment, where you buy plots or house or an apartment or a commercial complex. All these can be bought in by categorized into real estate investment. But the only issue with real estate that there is a certain minimum threshold where amount is needed to enter into a real estate investment. It could be a few lakhs or a few crores to get in. But in case of mutual funds or the other FDs or other investment, which I mentioned earlier, you can start with as little as a little amount of 100 rupees, 500 rupees, 1000 rupees to any amount, depending upon your saving. But in comes to real estate, there is a minimum threshold which has to be followed. And nowadays there are e-real estate options wherein you don't have to directly buy into the physical real estate asset of plot or apartments or commercial complexes, but you can buy fractional units of real estate managed funds or real estate managed entities are there, which helps you to buy into fractional of real estate, like the mutual funds how is managing on stocks. Then we have precious metal investment like gold, silver, platinum. Again, can be done through exchanges or even direct investment into gold and other investments. We have alternate investment like into art, wine, cryptocurrency. All these I have categorized as something like a exotic category where there is in some point there is no right regulation to manage the art or cryptocurrencies, or they can be invested, but most of the time it doesn't give you the right regulation and protection for your investment. Then there are further who is having high risk appetite can go for hedge funds, private equity funds, venture capital funds to invest in the startups, hedge funds and all. There are different opportunities. Then of course insurance is to as I spoke earlier, it is to manage your risk or financial erosions. Finally, let's talk about the financial planning part. So when it comes to financial plan, family, if you're married, you husband wife should sit together and figure out what is the Akhila, can I request to mute yourself, Akhila? Yes, thank you. So when it comes to financial planning, basically, an individual or a family have different financial goals. There are kids' education, that is the primary thing we need to plan for, as part of your financial planning. Then the kids' wedding comes. Then on an annual basis, you may have to plan for your vacation or your entertainments, how much money is to pay. Then tax planning, we have to pay tax. We cannot escape tax. But if you plan well and invest well, you can save a lot of tax. So basically, tax planning has to be done. And when you start earning itself, you have to plan for your retirement also. Because see, in current situation, it is not like the earlier days, once you get into employment, 55 years or 60 years, you can be in one profession. We don't know when your company will, give you a retirement. Could be early retirement or a termination. We don't know. So we have to very carefully on a long-term basis plan for your retirement also. Again, a couple of times I told, insurance also has to be planned and insurance planning has to be done so that it can be, protect your asset can be protected. Then the estate planning. Basically, estate planning is nothing to do with real estate or anything. Estate planning comes into play wherein, your wealth or earning has to be, passed on to next generation. We talk about it to, the middle age, professionals where, you are eventually, we talk about wealth creation, wealth preservation and succession planning. That is where, the estate planning comes into play. So all these are part of your financial planning to be done. And honestly speaking, anybody who is trying to do a financial planning and financial based, goal-based financial investment, it's always advice, go with a professionally qualified financial advisors or consultant who can help you in doing a financial planning. Otherwise, there are certain websites and apps which helps you to do financial planning online, which it depends upon your time and dedication into it to manage that. There are certain challenges which I was just mentioning, why you should do this financial planning through an advisor, because many of the times, you will have your goal, financial goal, but end of the day, to achieve this financial goal, there should be a monetary value or monetary investment to be done, wherein on a basis of, say, certain time limit which you plan, which we always say as the timeline, we have to achieve the financial plan. So which we have to input investment there. The investment has to grow, which has to be tracked every periodically, and rebalancing is required at certain times. And finally, you achieve your financial goals. Your financial goals could be construction of your house, your vacation, kids' education, buying a car. All these are part of your financial goals. But how to achieve it? It's a challenge which basically you need to sit with your financial advisor and do the investment. Again, there is a big challenge in today's world is as soon as you Google into financial planning or investments, you'll get a lot of informations, analysis, data, everything. But how to track on it, how to analyze it, how to do that right investment, it is a big challenge in nowadays, because you are dumped with lot of information and data, which many of us find it difficult to understand from the data. So that's again one challenge which in today's investment horizon face, too much of data. So that confusion can be, overcome by a proper financial advice. Again, one more slide where I was mentioning about the regulators. When you do a goal-based financial planning, I was mentioning about the different asset class. So in each of these asset class, the regulations you have to understand. One is stock exchange or stock investment is regulated by the Security Exchange Board of India, which is again equivalent to the RBI in case of banks. Again, bonds and other financial banking investments are, regulated by Reserve Bank of India. Long-term investments like PPF is again the Provident Fund Regulatory Authority manages it. Mutual fund again regulated by AMFI and Security Exchange Board of India. There are real estate investment, E-based, alternate investment, which I was mentioning. Again, it is regulated by SEBI. Precious metals holding, which is done online or through exchanges, again regulated by RBI. So all these investments, when you invest, you need to understand the different regulations behind the investment. So this is another key point which you need to understand before making any financial goal-based investment whenever you're doing. This is another thumb rule in financial planning which many investors follow, which probably you can also take a note of it, which can help you in doing a proper financial planning. Out of your total earnings, in general, when you do a family budgeting, 30% should be used for your, family living expense or your, day-to-day living expense. 30% should go for your liability repayment, wherein your liability of housing loan, car loan, or education loan, whatever it is, it should not be more than 30% is the general thumb rule which we advise. Third is 20% of your total income should definitely go to investments and savings before you spend on all the other things. So 30 into monthly living expense, 30 into your loan. Basically, we always advise, your EMI should not be more than 30% of your monthly income or annual income. 20% for savings. 10% you can take it for your entertainment and vacations and all your other activities. And most importantly, 10% should go for charity and type. Um, at this point, I should share my personal experience, because this is something which very diligently I do. I had been doing throughout my career this 10% charity, and I have never faced a situation where I have to really go borrow or beg money for meeting my livelihood. That is because I believe, this 10% which I pay, Lord is basically, helping me to maintain, because I can give you a biblical, proof for that, from Malachi chapter 3, verses 10. It says, bring all the tithes into the storehouse, that there may be food in my house, and try me now in this, says the Lord of hosts. If I will not open for you the windows of heaven and pour out for you such blessings, which will be, it continues, which will be abundance, which you will find it difficult to store. So here, two key wordings you need to use. Lord is saying, try me on this. You pay this tithe, and He will bless you so much that it will be very difficult to hold in your warehouse, or to store it. So till if I have started earning in, say, for last 22 years, and I have been following this very diligently, and till then, I tell you, you won't find it, any time where you will find it difficult to meet your life requirements. Just to give you an idea on returns on different type of investment, I'm just coming to the last part of my presentation, where I'm going to give you a prescription where you can earn your desired pros, whatever you have desired. So first of all, you have to understand the on a long run, the equities investment has given a more than 15 average 15% over 10 years or 15 years, and on a 20-year basis, a 13% return. Gold again has given most of the time about 10% return. Bank FD is closely to 5% on an average. 5 years or 10 years or 15 years you take, it is more or less stagnant at 5%. Real estate investment, property investment, the property challenge of property investment, there is no particular regulation where you can track it, but on a property basis, on apartments and other organized sector, it is saying that a long-term investment will give you only 6%, but shorter in periods they have given you more than 10% or 13%. CAGR on wholesale price index. See, there is something called inflation. 1 rupee today, sorry, 100 rupee today will depreciate after 1 year to an extent of 5% or 6%. So currently the inflation is more than 7%, but over an average it is around 6% across, if you see, or 20%. So we always, as financial advisors, say, the biggest risk in financial investment is not to invest, because if you are not investing, the problem is inflation is eating up your money. Your rupee valuation is going down. There is another slide which shows how a asset class has been performing each year. If you say 2008 in US markets, the bonds has given, corporate bonds have given 20% return, but the next year, if you see, the stock market has given 31%, and subsequent year, if you see, 27% has been given by gold investment. So what I am trying to show is, there is no one subsequent year where a particular highest performing asset class has performed the subsequent year also. If you see, each and every year, there is a different segment which is performing as the highest investment. So how to balance how to make a wise investment is to have a balanced portfolio. For example, if you take your current investment, the investment what you have made across your FDs equity and precious metal or other investment. It could be like more or less 70% into savings bank, or 10% into gold, or 15% into real estate. It will be a mix. But what I propose is, why? Because in the previous slide I shown you, it is, there is no single year where a particular asset has performed at number one position. The subsequent year it has continued that performance. So it is always advisable to have equitable distribution. 25% into fixed returns, where your FDs or SB account you need to manage. 25% into equity-based, direct equity, mutual funds, or other equity-based, private equity-based investment. 25% into real estate, and 25% into precious gold. Why? Because see, when, if you analyze, last year gold was performing at the top level, but last year there was a big crash in the beginning of 2020. There was a big crash in stock market, and stock market recovered. So this year, if you see, the number one performance is delivered by stock market, gold followed by gold, but real estate is just still picking up. So it's this particular asset allocation of 25-25-25 ratio will help us to give you an equitable returns of, say, around 13 to 14% across all the years. That is my personal experience when I try to manage my investors' money in this particular ratio. So that is something which you can practice while doing your financial based investment. This is very interesting part. The compounding concept. If you see a 5,000 rupees investment invested into 9% return and 12% return over a same period, as somebody who has started his investment of 5,000 rupees at 25 years, and at the age of 60, what could be the difference? If somebody who has invested his 5,000 rupees every month into a 9% return investment, at the age of 60, you will have 1 crore 63 lakhs 24,000. But a small difference of 3% makes a lot of difference. A 3% difference in return will give you more than double. See, if you see in the same person who is investing at 25 years, 12% return gives him 3.90 crores. So that is the power of compounding, which I wanted to explain while you are doing the investment. How fast you can multiply your money. Coming to the final slide, Suresh Gopi is Ningalko Agam Kodishwaran, or Kaun Banega Crore, Amitabh Bachchan's Kaun Banega Crorepati. So you can also become a Kodishwaran or a Crorepati with a simple prescription, with a simple investment which you can follow. You can invest 5,000 rupees at 11% for 24 years, will make you 1 year. Or if you want to have a shorter period, go for a 12% return with 10,000 rupees monthly investment. At 18th year, you will have 1 crore. So that is the prescription for me to earn whatever crores you want. Whatever crores you want, you divide with this much amount into this much years, you will be a crorepati. And this is something which I read today while preparing slide for you. All Christians are but God's stewards. Every day we have is on loan from the Lord, entrusted to us for a while to use serving Him. So whatever wealth you create or earn, it is a loan from the Lord for you to serve His people or for good. So with this, I'll take a pause. Maybe we can go for a Q&A session if time is there.
Yes, Sata, we will quickly move to the Q&A sessions. I'm sure most of us have a lot of questions that we want to have clarified. But before that, I'm just sending across a link on the chat. This is just a Google form requesting you to fill in your details so we could keep you informed about the future sessions that will be coming up in the following Saturdays. We'll give it probably 5 minutes, and post which we can start off with the Q&A session. And you have two options. Feel free to unmute yourself and ask the questions directly, or you could just post in your questions on chat, and Tito Chatton would help us through with that.
Tito Chata, praise God, Sanju here. Tito Chata, just wanted to know, because I was going through this app called Grow app, which is there on Play Store. Many people recommended that. Even my office colleagues suggested that. So there are a lot of mutual fund SIPs in that, and I'm not sure which one to select and how to go about it. So just wanted to know, how do you choose which one is the best mutual fund for you?
Some of these I haven't gone through Grow Up, but I am aware about Grow Up. There are there are certain other apps like Scriptbox which gives you a mutual fund advice. Or if you are already into some app-based investment platform, use a website called mutual fund. There are some mutual fund research. Sorry, I'm not getting it.
Mutual fund sahi hai?
I don't know about mutual funds here, but there is equity research. Sorry, I need to just do it. There are certain websites which exactly value research. Davis.
So do you recommend that, to go through the apps, or find the right financial broker for you, or how is it?
See, it's all.
I'm an entry-level investor. I don't know. About investing at all. So
I see in today's scenario, it all depends upon how much time you can spend on, analyzing such websites or apps where you can, rank it and then select it. So if you want to have a quick, investment, if you have access to a friend or somebody who knows you, just go to an investment advisor, take his advice, go to an online platform and do the investment. Many of the times, investment advisors will prefer to route it through their platform. Otherwise, there should be a mechanism where you can pay the fees for his investment advice and take the advice. But in case of mutual funds, I would suggest you can go through a couple of these platforms online. You can easily do the investment and track it also. So value research is something good. Money control is good to give you track the mutual fund investments.
Okay, sir.
Sanju, am I clear?
Yes, sir. Yes. Thank you so much. Yeah.
Bhaiya, I have a question with regard to you spoke about fixed returns and variable returns, right? Do you have a sort of advice as to what percent one should put into fixed returns and what percent one should put in variables? Because personally, I haven't started investing in anything variable as such, but my risk appetite as such is close to zero. I'm very scared of losing money in such investments. So what would you suggest? How does one draw the line between low returns and volatility versus high returns and risk?
Okay. See, if you're very risk averse, I would never suggest just depend only on bank FDs where it gives you mere 5 or 6%. Problem is your inflation will eat up your growth there. So what you need to do is there is something in mutual funds called the balance funds, where close to 70% or more than 70% is invested into fixed return investment, but slightly at 20 to 30% is invested into equity market. So the fixed return of this balance fund will protect your capital, and that little bit of 20% of their equity exposure will give you a fairly better return than your FDs or other fixed return, wherein you can beat in your inflation and earn a little bit extra income of the slight risk you are taking in. So for people, risk averse investors like you, it will be always advised to go for a balanced funds of mutual fund. And also, if you are a monthly income earning person, I would suggest go for a SIP mode of investment, which is called as systematic investment plan in mutual fund, wherein you are not parking your funds in one shot, but rather you are investing at different levels of market on a monthly basis or a quarterly basis, whichever is a comfortable mode you want to invest, and build it over a period of time, so that you are mitigating your risk with a systematic approach. So that two method of investment can help you to overcome this risk averse situation. Lionel, is it clear, Lionel?
Got it. Yes. Thank you, Bhaiya.
Tata, there is a message in the chat box regarding cryptocurrency. So,
okay. See, I am not an expert into cryptocurrency. So, plus what I was trying to educate was more of the regulated investments in India. Cryptocurrencies or the bitcoins or other investment options are available in India, and many of them are trying into new cryptos. Problem is it is not regulated yet in India, so I just want to keep it away. Further, I haven't studied into depth of this cryptocurrency and not in a position to advise on that. But there are options and opportunity where people are investing, and from India also we can do. But as I was saying, whatever investments you do, it's always better get into an investment which is regulated by a government body, for which gives you some kind of protection in terms of what happens to your money and how can be recovered and all the other settings.
Okay, thank you, sir.
Hello.
Yes.
Okay, I just had a question. Isn't investing in stock markets a kind of gambling? Because Catholic Church is not, or what is Catholic Church stand on this way of making money?
Okay, fine. Now, not all the investment in stock market is gambling. Why? Because there is. Let me explain one more thing. Like there is an opportunity in stock market where you can gamble with your money. That is something like you put in a little bit X amount of money and you take a more exposure, wherein you can buy stocks with more borrowed money, and without the stock you can sell the stock and all those, which I would personally suggest not to do, because that is definitely gambling. But in stock markets also, there is a legitimate way of investment and doing. Why? Because see, first of all, you need to understand what is the stock investment. Basically, a promoter or a startup which is going to start a business, the promoter doesn't have his capital or money to invest into business. So he comes out and takes investment, or sometimes borrows money, which is called as debentures or bonds, or equity issue shares. Shares, and starts the business. Once the promoter or the entrepreneur starts the business, he is earning profit, which is not only for him, but it is for the investor also, who has invested money with the promoter, trusting that this business will grow. So tomorrow he has to give back the return. So that returns comes in two ways. One is as dividend out of profits what he makes, which is any shareholders get from the company as earnings of the profit. Number two is the capital gain part, wherein the stock price moves ahead with based on the future prospect of the company or the promising product or future guidance, wherein there is a capital gain. Like in real estate, why you invest in real estate? Just buying a piece of plot, you keep it for 3 years or 5 years, and then you sell it. You haven't invested anything into the real estate, but you make a gain. That is called the capital gain. Similarly, in any investment, there is a capital gain part where the gain comes out of the prices it quotes in the stock exchange. So there are two types of earnings into equity investment. One is the dividend, which is a share of profit. Another is the capital gain, which comes out of the gain of price appreciation happens in the market. So that part, where you invest into the company, wait for certain period, 3 years or whatever time horizon, and earn. I mean, it is very legitimate and it is legally permitted and it is a good earning share. But the other part, wherein you over borrow the money, you do a kind of a guesswork in the market, put the money to earn quick money or profit. That is something which is known as the kind of gambling in the market, which I think we all should avoid and not to get into it. James, is it clear, James?
Okay, thank you. Yes.
There are some direct questions. Views and futures and options. How best we can. Okay, somebody is asking my views on futures and options. Again, futures and options are a derivative investment where a lot of risk is involved while getting into that. So one way is to have good knowledge of futures and options if you want to trade on that and invest, or better not to do it. There is another way of handling this futures and option, which is a little more interesting to do, because see, when you are investing into a market and you fear that market may go down, there are protection like the insurance you take for your life or for your vehicle. Similarly, futures and options are kind of a insurance where a little bit premium is paid on the options or futures and a protection for the downfall of the share. I think this you can even go through YouTube videos and other links which gives you more idea on futures and options, how it can be hedged against your risk. That is called hedging, basically. Then how can we get best value subscriptions on new IPO? Again, the IPOs what are happening at this market, basically most of these IPOs are fully priced. I don't find much value nowadays in IPOs because most of the promoters are issuing shares at very high price. So again, to get best value out of IPOs, you need to go through the balance sheet, study the valuation and all those, which gives, again, there are websites which gives you, even in Grow app also, they give you the in-depth analysis on each IPO when it comes whether to invest or not. So better take such advices and knowledge before getting into IPO investment. Then how can we get best value subscription on new IPO? Because there is a general consensus that clearinghouses take best part of IPOs and yeah, this is what something else I was saying. Most of the time, many of these IPOs, I find it basically they are overvalued and not much is left out of to get a listing gain. But if you find some good promising concept or business model where you like to invest, you can invest and get return. But again, it's very difficult, unlike the earlier days where we had a lot of opportunity in IPOs. Any more questions?
Chada, do we have any platforms where we can actually learn about the analysis part and maybe figure out which one to invest? Do you have any suggestions where we can learn some other than YouTube?
See, what you said is right. Most of these YouTube channels, they don't give you a I mean, there are free things, but I would suggest go for the paid ones, because the paid ones are more reliable and they have some responsibility towards into what kind of advice or analysis they give out. Somebody is recommending Zerodha Versati. I haven't gone to Zerodha, but yeah, if Zerodha is something I also hear about, that you can follow. So my simple concept is, whether it is technical analysis course or a fundamental analysis course or any investment analysis course, better go for a paid one rather than the free one, so that it is reliable and they have some kind of responsibility in terms of the advice what they give you. Because the free advice or free videos, most of the time it is paid by somebody else to basically, keeping into achieve some of their hidden agendas, out of making this. Yeah, CA Rachana Patkar, very sensible lady. I have been following her. Sarik Samsudin is also quite good. But all these will give you only a basic idea of investment and all. But somebody was asking about analysis, fundamental analysis, technical analysis, courses and all. I would always suggest go with for the paid one rather than the free one.
Do you have any suggestions where we can look into something like that?
Oh my God. I personally, I haven't used anything, but there are plenty available. Maybe I can find out, Christian, you can just, chat with me on WhatsApp. I can, from my contacts, I can get you.
Okay, Jada, thank you.
Like Muthoot banks which give higher returns compared to the other government public sector banks.
Sorry, I didn't hear you. Can you come back, please?
There are these banks like Muthoot Bank which returns are higher than the other public sector banks. What is the risk there? What is your suggestion?
Okay. See, I think I forgot to mention about the rating. So whenever you're going for a bond investment, many of the times these companies like Muthoot, Manappuram and all, they issue NCDs, non-convertible debentures, which is like, a loan which they are taking from public to meet their business operational requirements. So you have to look at into the ratings what they give. Many times you will see double P plus, triple B. All these ratings will help you to judge what kind of risk you are getting exposed. Muthoot, definitely a reputed group from Kerala. They have a pan-India presence and overseas presence also, and rating-wise also they are quite good. And because see, companies like Muthoot have to give a higher interest than SBI or any other public sector bank. Otherwise, nobody will invest with them. But definitely there is a slightly higher risk compared to the public sector banks. But the business model what they're following, that is what you need to check in. That's what I was mentioning during the presentation. How are they generating their income to pay you back your return? That is the key point. So if you understand that business model, for example, Muthoot, they are into gold loan based, predominantly gold loan based lending. So gold is more of a safe asset which is kept at their locker and lending happens and money comes back. So that is something which you can understand with your knowledge or brains. You can invest. So whenever an investment option comes, it's the question you need to ask: how does this return comes back? How they are going to invest this money and come back. If that gives you some understanding, that makes sense, you can invest and go ahead. That's my take on it.
As a question regarding Muthoot Gaming, I just heard from a Muthoot professional and he assured one of my friend a 10% return on their FD. So is that actually legal even though if they are NBFC?
Yeah, 10% is legal, but then the rating would be little low. That's why they are offering 10%. But again, that if it is, I don't know, I haven't heard any of the Muthoot group giving 10%, but if Muthoot is giving that 10%, it is good. But I don't think nowadays they give you anything more than 9. 9 is the best, I think, what I heard. Somebody was asking what is the opinion about multi-asset fund. Yeah, multi-asset fund is a good option, wherein they invest into different asset class into a single fund. So again, a diversification and mitigation of risk happens in the multi-asset.
Jada, do you know about small cases? Small cases. I've heard that it's a group of it's like a group of stocks or something like that. I don't know exactly what it is.
Stock cases.
Small cases.
Small
It's
cases.
yeah. I think it's a new concept that they introduced. They make a bunch of stocks together, and you can purchase those as a case. Like it comes as a case with a lot of different stocks according to the different industries. They have planned a lot of things. Yeah, I think that's a different thing to talk about.
Okay, on my mobile, when I searching, it is something like a mutual fund investment only, wherein they have a basket of um, basically asset like stocks and other investment, and it is helping into investment. So it is something like a mutual fund investment only, wherein it's very easy to enter and exit into the investment. Yeah, it's
But
something
I
like
think mutual funds, there will be a fund manager who changes the stocks and stuff in between, right? But I don't think so. The small cases, it's like a fixed basket of stocks which we can enter and exit. I believe that's what it is.
Okay. See, for any of such investment, SEBI regulation should be applicable. So just check whether on the website of SEBI, have they any kind of approval which they have taken, and they have floated, then it is legal to enter into that. So whenever you find such a proposals, just quickly get into SEBI website and check under what category it is listed. If it is not listed, then you have to take your personal call whether to be invested or not invested. But in case of this small cases, I think it's legally permitted and it is a legal structure to it. There is a legal structure to it. Yes.
Jada, as an investor into stock market, what do you think would be the percentage that we should aim at getting as a return from stocks? Is there any number like that, or should we concentrate on a number, or should we just buy stocks and just leave it as it is, and pray to God that it goes up sometime?
Fundamentally, you need to follow 2-3 parameters. One is that your stock investment should be for a long-term investment. Basically, I would advise at least for 5 years. 5 years and above is a good ideal period to have a stock investment. But there will be certain years like last year, from 2020 March till 21 March, if you see, many of my clients have made more than 100%. They have doubled their money, but which cannot be expected for next 2 years or 3 years. I don't know whether it will happen or not happen, what kind of return market will give you. But the key is, stay invested for long term, at least for 5 years into any stock investment, because there is a cycle into every stock market rally. There is a up, there is a down, then there is again a recovery phase. So a cycle to complete more or less, it takes 3 to 5 years. So it's always recommended to stay invested for 5 years whenever you are doing a stock market investment. And if you're doing a direct share market investment through any of the apps or stockbroker, I do advise at least once in 6 months you need to evaluate the stock prices and stock movements, even the company balance sheet management and all. And if there is anything going wrong, you need to rebalance it. At times, you may have to sell in loss, buy in other stocks and all, but you need to basically monitor it. But if you don't have the time and know how to monitor, manage, rebalance and all, it's always advisable to go through a mutual fund manager into mutual fund schemes. But again, you need to leave it for 5 years or plus investment horizon, but the management always is taken care by the fund manager. So that is how you need to decide on investments, especially stock investments. Robin, if I am taking more time, you can interrupt. I am fine. I mean, I can take any more questions. That is I am free. But if time is already 7:35, if you have any time issue, you can cut short. No issues.
Cheda, there is one more. So I'm so sorry. I'm asking a lot of questions. I just got into
No.
investing
Please,
and I
please
don't
ask. Come back. No problem.
Okay, so
Yes,
Cheda, I
Christian.
have so I have a small chunk of money which is like long years of savings. I just started saving like few months back, and that's my savings. That's all I have. And I have heard that the stock market is already a bubble that is almost ready to pop because of a lot of people have started investing their money in stock market because they don't have anything else to do with it because of the COVID and lockdown. So do you think there's a situation like that, and should I wait to invest, or is there as people say in the stock market, is there an entry point right now? Is there an exit point right now? Should I be looking into something like that right now?
Yeah, Christian, actually, it's a wonderful question which you have asked. And the answer to it, what I'm going to say is, it's my personal view. It is not based on any other formal analysis or it's only based on my past experience and it's my personal view. See, stock market always should give you a reflection of the economy situation. Now, if you see the latest GDP numbers 2 weeks back, you might have read it has come to minus 7.3, which is very alarming, which is, I think, in the third or fourth time post-independence era that we are facing such a drastic low GDP, or rather degrowth in our economy. So in a degrowing economy, stock market at all-time high is really alarming. It's very alarming situation. So for any investor who is planning to do a lump sum one-shot investment at this point, I would say it is not a right time. You need to be very careful in doing such an investment. To solve this issue, because we don't know up till what level market will go, at what level it will crash, and also it's only some kind of a precaution or strategy which you can adopt to avoid such crash or eventualities. So what I suggest is it's better to park your money into a debt fund of a mutual fund wherein fixed return comes in, and there is a system called systematic transfer plan, STP called. It's called as systematic transfer plan, where you can mark a particular monthly amount which has to move from this debt mutual fund to the equity fund on a periodic basis, monthly, quarterly, whatever time horizon you want. So at each month, whenever the investment goes, if market is high, you will get less units, and market is low, you will get more units. So in that way, you can very well address this ups and downs, or further if you expect a crash, your money will not be exposed in one point of time, and the sudden crash will not affect you that much if you go to such a STP plan. Yeah. So what you heard and what you hear about the market, even personally, I do, see such a, uncertainty in market, which is not a good time to get into a fresh investment at this point. But eventually, SIP model, a monthly investment plan, or a STP, systematic transfer plan, could be a option to mitigate this risk.
Chera, I have a question. My name is Jitin.
Yes,
so like you mentioned, last March 2020, I did some investments and I have got good returns as of now. So the situation you mentioned now, so should I pull back all the funds now because like you told about the situation is very alarming, or should I wait for a little bit more longer to expect more higher returns? What would be a prudent decision as of now?
Okay, so before coming to the answer, I would say whenever you do a particular investment, whether it's a stock investment or a real estate investment or any other asset class, basically before entering into the investment itself, you should have a target on your returns also. So if you feel the funds you have invested last March 2020 has met your target and you have, or at times you might have overachieved your target also. If that has come and you feel like it's a good return, you can very well go ahead and withdraw, which I won't say you should withdraw or don't withdraw, because I don't know where the market is heading tomorrow. So my advice is, always have your targets in place before making an investment. And when the target is achieved, it's always advice is to withdraw and park it elsewhere, rather than timing the market. What will happen to the market? See, nobody can really predict, tomorrow this is certainly going to happen. Like I said to Crispin earlier, the range at which the market is behaving or is at the moment is little alarming, and you should be careful. But withdraw your money or not to withdraw, it's your personal decision, which depends upon your target earnings which you had when you made this investment. Because any point we cannot judge, what could be the highest point. It is later we understand, okay, 52,000 index, or this particular index was high when the market starts crashing.
Thanks.
What do you think? So, see, I just joined one of the Kerala Overevening group, so I just heard all these things from there. I've heard that you can put a yearly stop loss for a stock which is already trending a little high, so that even if it crashes, you won't lose much. Does that work like that?
Yeah, there is stop loss mechanism in the stock exchange. Some of this app and exchange provide that facility, which can be used to protect your profits from going down. That can be utilized. Yes.
Cheda, I had one question. So this Kerala government treasury, right? So they were providing more than 8% interest in the return. So is it safe to actually invest there, or like even NBFCs also, some of them actually, like say the ESAF and all, now they have reduced, but they were providing some higher percentage. So should we like kind of go ahead with the risk, or like is there any risk in them?
See, all these government bonds and securities are a good investment to make. But my personal view on Kerala government issue is the kind of debt what they have. It's very alarming. Something like 3.5 lakh crores is the debt outstanding outside. Plus, with this corona and the revenue of government going down, I don't know how far government treasuries will be able to service those interests, because it is a big uncertainty over there. But we cannot say unless they default, it's a risk or not. But yeah, 8% is a decent return for a government instrument out there. Yeah.
Okay.
Thank you all. I'm sorry to interrupt. We may have to end this session.
Yes, Nikita, no problem.
Thank you so much for your time, Cheta. So like we said, we will have follow-up sessions in the coming Saturdays of 9 and 26. In case you have further questions, feel free to drop a message to Robin Chatton or me. We'll definitely share it with Chatton. And once again, thank you so much, Cheta, and thank you all for joining us.
Thank you, Nikita. Thank you.
Thank you.
Thank you, everyone, for your patient listening and good questions asked. Hope to meet you all soon.
Thank you,
Wish
Cheta.
you all the very best. God bless you all. Thank you. Good night.
Cheta, you are the host now. Can you end the session?
Oh, sure.
Thank you.